millions of people lose money. In the 2008 financial crisis, everyday wealth was wiped out almost overnight. From that crisis to more recent market drops, the pattern remains the same. When the bottom falls out, public investors panic. Yet, while the vast majority are left with nothing, a specific tier of institutional banks reliably comes out on top. They don't just survive these downturns, they profit from them. How is it mathematically possible for mass financial catastrophe to equate to an institutional windfall? Their success is a product of a highly specific system that we can audit timeline by timeline. Weeks before a crash, the average retail investor is operating in a blind spot. Relying on mainstream news and lagging indicators means they only see the problem once the damage is already done. This grid represents the raw data banks monitor. They have unfiltered access to massive inputs before it reaches the public. Tracking these capital flows, they see smart money exit vulnerable sectors while prices still look stable. During that exact same window, retail investors often feel secure, assuming the growth they see on the surface will continue. This preemptive view of global money movement allows the bank to move based on data, rather than reacting to sentiment. This chart highlights the moment a trend line hits a subtle downward inflection point. This first sign of foundational weakness marks where the public and the institution go in opposite directions. Faced with this weakness, the average investor usually freezes. They ignore the data and hold their positions, hoping for a quick bounce back. The institutions act first, shifting capital out of high-risk assets before the broader panic sets in. They also utilize hedging, a mathematical bet designed so that if the broader market fails, the hedge spikes in value to offset the loss. By acting in this strategic window, the institution builds its profit engine before the crash even hits the news. When the bottom finally falls out of the market, the resulting financial crash is sudden, violent, and completely unforgiving for the unprepared. This triggers a psychological breaking point for the public. Driven by fear, retail investors capitulate and sell their assets at rock-bottom prices. While the public sells, the institution executes. They systematically buy those discounted assets from the panicking public. At the same time, the hedges they placed weeks ago are cashing out. This provides massive liquid capital precisely when assets are cheapest. The institution's superior timing utilizes the public's panic to fund their next phase of growth. Looking at the aftermath, the reality is clear. The bank's survival is an engineered outcome. It is built on three scalable mechanics: information gathering, hedging strategy, and preemptive timing. During a crash, the stock market acts as a direct wealth transfer mechanism from the emotionally reactive to those who follow these mechanics. This leads to a final question about your own financial posture. When the market shows weakness, are you reacting to it, or are you understanding it? Surviving the next crash requires moving past emotional reactions. It requires the same discipline the banks use: looking at the data, building a strategy for the downside, and waiting for the right moment to act.